We've got the dense regulatory filings from Bank of America's 3Q25 results right here. And, well, our mission today is pretty straightforward. Break down the core financial health, the operational wins, and what the future might hold. All from these documents, we aim to give you the essentials.
And, the headline this quarter, surprisingly strong, I'd say. CEO Brian Moynihan highlighted accelerating momentum. It seems driven by, well, really excellent returns on both assets and equity. The bottom line numbers, they paint a very clear picture. Revenue growth just really outpaced expenses significantly.
Okay, so let's jump right into maybe the three biggest numbers driving that momentum. What stands out?
Certainly. Okay, we're looking at some pretty massive year-over-year gains here. First, revenue net of interest expense. That hit $28.1 billion. That's up 11% compared to last year. Big jump.
11%. Wow.
Yeah, and that drove net income to $8.5 billion. That's up 23%.
23%.
And that translates directly, as you'd expect, into diluted earnings per share, or EPS. That soared 31% to $1.06.
That kind of revenue jump, I mean, it really makes you ask, where did Beaufry actually make its money this quarter? Because it wasn't just the balance sheet growth, was it? The data seems to show surprising strength in their fee-based businesses, too.
That's absolutely right.
Yeah.
Takeaway number one has to be that strength. Investment banking fees, for example, topped $2 billion. That's up a massive 43% year over year.
43%?
Yep.
That's huge. But is there context there?
There is, yeah. That 43% gain is, well, it's staggering. But you have to remember, 3Q24 is a pretty low point for the whole industry.
Right.
So what's maybe more meaningful, or at least as meaningful, is the sustained performance in sales and trading revenue. That was up 9% to $5.4 billion.
Okay, 9% is still very solid.
It is. And crucially, it marks their 14th consecutive quarter of year-over-year growth in that area. So that shows they aren't just benefiting from, a one-off market improvement. They seem to be consistently grabbing market share.
Right, consistency is key there. And this market success, it seems like it ties directly into our second takeaway, operational discipline. Because when revenue grows that fast, costs can often get out of control, but sounds like that didn't happen here.
Exactly. No, they managed to drive 5.6% operating leverage, good positive leverage.
Which means they're getting more efficient, essentially.
Precisely. More performance for every dollar spent.
Yeah.
And critically, their non-interest expense was only up 5% year over year, landing at $17.3 billion. Now, when you combine that, controlled spending with the big revenue surge, their efficiency ratio, which is a great way to look at margin, it actually improved, dropped 329 basis points down to 62%.
Okay, 62%. Better is lower there.
Correct. Lower is better. They're essentially running twice as fast as their costs. I mean, that's really the definition of a healthy operation right now.
Okay, let's shift gears a bit to the fundamentals. The third key strength seems to be their balance sheet, and specifically organic client growth.
Yes, absolutely. Average loan and lease balances grew 9% to $1.15 trillion.
9% growth on loans.
And that growth was across every single business segment. It wasn't just concentrated in one area.
That's broad-based then.
Very. And coupled with that, look at their core funding source. Average deposit balances. They increased 4% to nearly $2 trillion.
Almost $2 trillion in deposits.
Yeah. That sustained growth, on both sides of the balance sheet, assets and liabilities, it demonstrates pretty robust client confidence in their core banking model.
Okay, so the growth is there. What about the risk side? Our fourth takeaway seems to be improving asset quality, which is maybe a little surprising given how fast loans grew.
It is kind of interesting, right? Because you often watch for rising defaults when lending picks up that much. But what's fascinating here is the bank's apparent confidence in its borrowers. They actually saw a net reserve release of $72 million this quarter.
A release, so they took less provision.
Exactly. For you listening, that means they reduced the amount of money they had set aside for potential bad loans. Their models are suggesting the loan book is pretty stable. Provision for credit losses decreased overall to $1.3 billion, and net charge-offs, the actual realized losses, also dropped.
So better credit performance than expected.
Okay. Fifth and final takeaway, it feels like we have to talk digital.
Oh, absolutely. Digital dominance. This is really the engine behind a lot of that efficiency we mentioned. The scale is just, well, it's almost unbelievable. You've got 49 million active digital banking users
39 million.
and 4.2 billion digital logins in the quarter. That's up 16% year over year.
Billion with a B. Wow.
Yeah. And look at Zelle specifically. Active users grew 7%. They sent or received 459 million transactions, worth about $143 billion. That's clearly the low-cost future for how they interact with and keep customers.
That scale is incredible. It really underpins the efficiency story. It does. And that digital foundation, it supports their strong outlook too. The guidance, for instance, expects continued operating leverage into Q4. And their net interest income, NII, is projected to be quite robust. They're guiding $15.6 billion to $15.7 billion for the fourth quarter.
So a strong finish to the year expected.
Seems so. However, managing this kind of scale, it always brings risks. It's unavoidable. The filings do highlight potential impacts from, say, adverse developments affecting the U.S. or global banking industry generally. Standard stuff there. But also risks related to ongoing litigation, specifically concerning electronic payments, like potential fraud within that massive Zelle network we just talked about.
Right. Scale brings risk. Okay, so let's synthesize this for everyone listening. What does it all mean? Well, 3Q25 for Bank of America seems defined by strong organic growth, both loans and deposits, coupled with a highly efficient cost structure, and then add in that market-beating fee performance, particularly from investment banking and trading. It looks like they performed well on really every front.
Absolutely. A very solid quarter across the board. They are performing. But, building on that massive digital success you highlighted, the 4.2 billion logins, the huge Zelle volume, it does raise an important question, maybe something for you to think about. Given their clear reliance now on these client-facing technologies, what's the next frontier? What's the next challenge for growth or maybe risk management they really have to master? Is it just about scaling these platforms even further? Or is it really about mastering things like AI and machine learning development to stay ahead of, say, fraud and just the competition?
That's a really interesting question. Definitely a deep dive for another time, perhaps. For now, though, we hope we've given you the essential story on Bank of America's third quarter. Thanks so much for joining us on the deep dive.